Yes, so we're very much bottom-up stock pickers. So we don't look at the benchmark or index at all. And we also favour medium-sized companies over large-sized companies. And this is because medium-sized companies tend to have much more of a management control than very large companies. And they can also do much more interesting bolt-on acquisitions at lower multiples. And that's because if a large company wants to buy something, it tends to be very well looked at by all its competitors, and they tend to get more like fair value for the acquisition. Whereas in medium-sized companies, they can often buy family-controlled businesses, and actually sometimes the multiple they can pay is very, very low, such as 5 or 6 times EV/EBIT, which really creates value over the long term. So we always have our 4 main pillars or points that we look at. The first is the business model. So here we want a company that is fairly resilient and handles downturns fairly well. So, for example, we look at 2009 and what happened in the financial crisis and the recession that followed. So, for example, what happened to organic growth? Did it increase or did it decline quite significantly? And also what happened to the cash on the balance sheet and the net debt levels, and also the profitability. And that gives quite an easy view of how cyclical the business is. And we like companies that can handle downturns quite well. We also like companies which have a bit of structural growth, and this is because they have a particular niche or particular area that's growing. So, for example, in flavours and fragrances such as Kerry and Givaudan, they are increasing their share of the flavours and fragrances with their customers, and they also help the customers do, for example, less salt or less sugar in some of their foods. So that's a nice sort of structural growth angle. The next important point is the management, and if we're buying shares in the company, we definitely want the CEO to have bought shares, or if he or her has founded it, to actually have a big stake in the business, because that means that hopefully they are thinking a lot about the share price going up rather than necessarily just empire building or running the business for their own bonus, which might not be linked to things which make the share price always go up. So that's on the management side. And then thirdly, valuation. We tend to like to buy things, obviously like a lot of other people, on lower valuations with an interesting dividend yield, and also things which don't have too much debt. So a lot of our companies in our portfolio have net cash, for example. And then the fourth point, which is quite key, is that the return on capital for the fund, if you look at a weighted average of the fund portfolio companies, is about 25%, but it's only 13% in the index. So you can see that actually if we start off today at about the same valuation, then if you give it 5 or 10 years, you should see the jaws of outperformance opening up, because one is making double the return on capital of the other one. And obviously the reason we meet all the companies the whole time is to ensure that that return on capital is sustainably high. So it always seems to mean that the fund has a overexposure to what's called industrials, but actually this sector, in a way, is a sort of general classification for lots of companies that can't be classified elsewhere. So actually, if you run down some of the largest holdings we have in industrials, they tend actually definitely not to be metal bashers or what you might consider to be industrial companies. They tend often to be in outsourcing or services or testing and inspection, or even actually some things which are linked to IT services or IT outsourcing, which is definitely not an industrial, but it does look like we always seem to favour those types of companies. There are some companies which tend not to have family ownership as well. So banks, for example, and general financials tend to have very small numbers which are actually controlled by individuals. And obviously we prefer companies which are controlled or have large stakes with management. So that tends to mean we're usually a little bit underweight in banks. No, we've never owned any unlisted companies, and we're very focused on liquidity. So in 2008 and 9, obviously that's when the market was very low and there were also a lot of redemptions. So, and we always managed to obviously meet daily liquidity at that time. And what we always look at is how much of a company we own, and we very rarely go above 3 or 4% of an actual company that we own. So since launch, the fund is very much first quartile. This year, 2019 to date, the fund is about the same as the market. In Q4 2018, we unfortunately did slightly underperform the market, and this has been one of the first times we've ever underperformed in a down market, and that was because there was a little bit of price earnings or valuation compression in some of our medium-sized companies, whereas a lot of investors in the wider market ran towards utilities and telcos, which have not really given you any returns over the longer term, but obviously outperformed in that quarter. When we speak to management of companies, both in the portfolio and in the general market, most of them are not hugely worried about Brexit, but that's because a lot of them, the UK might only be a couple of % of sales, and actually it tends not to be an import-export type company. For example, ISS might employ people who are working in buildings in the City of London, but actually those people hopefully will still be working after Brexit. So they're not hugely worried, it doesn't seem, it seems, about Brexit. Obviously, from a macro point of view, it just depends on the nature of the departure, which is obviously quite difficult to predict at this moment. So we're not hugely predicting what will happen, and therefore the choice of companies, because generally speaking, our companies are very pan-European or very global businesses, and therefore actually the exposure to the UK itself is very small.